Ever heard of an ETF but wonder how it really works? Let's dive in and unravel its secrets. Like when you've seen a magic trick and always wanted to understand the real deal behind those seemingly impossible moves. An ETF, or exchange-traded fund, is a bit like a magical treasure chest that holds lots of smaller treasures inside. These treasures are usually little pieces of ownership in different companies. When you buy an ETF, it's almost as if you're buying a share of all these tiny pieces put together. Now, imagine you and your friends decide to start a lemonade stand, but instead of each owning one whole stand, you all pool money to buy just the lemons, sugar, and cups while still sharing in the profits. That's kind of what an ETF does, but with much bigger and more diverse assets. So, how do these magical treasure chests work their magic? Stick around because we're about to pull back the curtain. Okay, so let's dive into the next layer of how an ETF actually works. Think of it as the construction phase. Just like a builder needs bricks and mortar to build a house, a fund manager needs to gather the right building blocks to create your ETF. Imagine you're planning to build a model airplane. You need pieces for wings, fuselage, tail fins, and so on. Similarly, a fund manager has a list of stocks or bonds they want in their ETF. They go out there like they're on a shopping spree and buy up all the necessary parts. These are the individual investments that make up the ETF. And here's the surprising part. Not only do they buy these parts, but they also ensure that each piece is just right for the blueprint of the ETF they're building. It's like making sure every wing on your model airplane has exactly the same measurements to fly smoothly. This meticulous process ensures that the ETF mirrors its target index or asset class as closely as possible. So, in this step-by-step process, we're learning how an ETF is built piece by piece. Just as you'd rely on a skilled builder to construct your model plane, investors rely on fund managers to carefully select and manage their investments within the ETF framework. Now that we know how a fund manager builds an ETF, remember, it's like assembling a big Lego set. Let's dive into the nitty-gritty of portfolio creation. Think of each brick as a piece of stock or bond that helps build our ETF. Here's where things get really interesting. Every time a new investor signs up for an ETF, the fund manager has to carefully choose bricks, yes, stocks and bonds, that fit perfectly with the ETF's goal. It's like picking out the right Legos to match the picture on the box. And here's the surprising part. The fund manager doesn't just pick any old bricks. They have a set list of rules that dictate which ones get chosen. For example, if it's an S&P 500 ETF, the goal is to mirror the performance of those top 500 American companies. So, the manager looks at each company and decides how many shares or bonds to buy of each one, just like carefully selecting Legos to match the model. The third thing that surprises everyone is that this isn't a one-off process. It happens constantly. The fund manager has to keep an eye on the market every day, making sure the portfolio stays true to its goal. If some companies grow bigger or perform better than expected, more of their stock might be added to balance things out, just like you'd adjust your Lego construction as you go along. By the way, all these constant adjustments are why ETFs can change in value from day to day. It's not magic. It's just part of maintaining that perfect match between the ETF and its goal, brick by brick. And now, here's the part that really surprises most people. How an ETF uses indexes as its blueprint. Think back to our brick analogy. We have a pile of bricks in front of us, and we need to build a specific structure. In this case, the structure is the investment portfolio for your ETF. But who decides which specific bricks or stocks to use? Here's where it gets interesting. An index acts like an architect's blueprint. Just as a blueprint tells you exactly which types of blocks, or in our case, stocks, to place and in what order, an index tells the fund manager precisely which securities to include in the ETF. For example, one popular ETF tracks the S&P 500 index. This index includes the top 500 largest U.S. companies by market value. So, when a new investor buys into this ETF, they're essentially buying a piece of ownership in all those 500 companies collectively, no matter which specific ones they were thinking about. The index isn't just any list. It's a carefully curated selection based on factors like size, industry, or sector. These indexes are created by financial experts using complex formulas and criteria to ensure the ETF mirrors its underlying benchmark as closely as possible. So remember, even though you might be buying an ETF labeled with a specific name, what you're really getting is exposure to that particular index. That's why ETFs can track everything from tech stocks to emerging markets, because there's an index for almost anything. This might seem like a subtle point, but it's crucial because it means every investor who buys into the same ETF is essentially buying the exact same basket of securities. This consistency ensures that no matter when you buy or sell, your investment experience remains aligned with the overall market's performance. Now that we know the role of indexes in forming an ETF, let's dive into another key part of how it all works. Imagine you want a piece of this ETF action. You buy shares just like any other stock, and they trade on exchanges like any other. Think about it this way. When you go to a grocery store, you see fruits and vegetables in the aisles. The price is clearly marked, and whenever someone buys or sells, that price changes based on supply and demand. It's the same with an ETF on an exchange. Each share of an ETF is like a little fruit in the aisle. People come and buy it, and others sell it. Here's what happens when you decide to trade. You place your order through a broker who connects you to the trading platform. Your order then enters the order book, which is like a big blackboard where all the buys and sells are listed. On one side of the blackboard, there are people willing to buy at certain prices. On the other, people willing to sell. Now comes the magic part that many people don't fully understand. Every time someone places an order, whether it's to buy or sell, a buyer meets a seller. This is called a match. When you place your bid, and let's say it's for $100 per share, it needs to meet at least one ask from someone selling at $100 or lower. Once there's a match, the trade happens instantly, and both parties get what they want. You own a piece of that ETF, and the seller gets your money. This process is incredibly fast, often in milliseconds. It's so quick that the price of the ETF adjusts almost immediately to reflect this new transaction, ensuring that everyone who buys or sells at that moment pays the same market price. So, whether it's stocks, bonds, or anything else trading on an exchange, every single trade follows this exact process. And for ETFs, since they're built from underlying assets like a basket of stocks, you can get instant exposure to their value through these simple trades. So, you know by now that an ETF isn't some mystical investment tool. It's really just a collection of assets packaged for easy trading. Let's break it down step by step. First off, think of an ETF as a basket of apples. Just like you can buy an apple from a store or get a whole bushel to share with friends, you can trade individual stocks on a stock exchange or buy a bundle of them through an ETF. The advantage here is that these bunches of apples, or in our case, assets, are easy to manage and sell. Secondly, imagine this basket has a label or a name, like the Apple Basket Fund. This fund could be made up of different types of apples, maybe some from local farmers and others imported from far away. In investing terms, these would be like a mix of stocks from various sectors and regions. The fund managers decide which assets to include based on their strategy. Now, here's where it gets even more interesting. When you buy an ETF, you aren't buying the actual holdings directly. Instead, you're buying shares in the fund itself. These shares represent your ownership stake in that basket of apples, assets. And just like with real baskets, if the price of apples goes up or down, so does the value of your ETF shares. The third one surprises everyone. ETFs are also designed to be as close to a perfect replica of their index as possible. Think of it like copying an exact recipe. The managers work hard to make sure that every time you check in on your investment, it mirrors the performance of its underlying assets, whether they're stocks, bonds, or even commodities. So there you have it. ETFs aren't magic. They're just a convenient way to invest in a group of assets. They offer diversification, easy trading, and often lower fees compared to buying individual stocks or funds. If you'll never look at planes or ETFs the same way, you know what to do. Subscribe and join us next time.